Welcome to the Cardinal Commentary for the Canadian equity portfolios. If stock markets are your guide, you could be excused for forgetting Canada is still engaged in a trade war with the United States. The S&P/TSX was the third best performing index in the world during the second quarter, returning 8.5%, trailing only Japan and the US. But make no mistake about it, we're most definitely in a trade war. While a number of industries have certainly been impacted, such as steel and aluminum producers, there has been little impact on the overall Canadian economy. Inflation remains below the Bank of Canada's target rate, for example, although it did inch upwards in June. The good news is we believe the tariffs and threats of tariffs won't be an issue much longer. Portfolio manager Sheila Wilson says investors reacted quite negatively when tariffs first surfaced as an issue, but that's no longer the case.
And essentially, investors are looking at the tariff announcements more as a negotiating tactic by the U.S. than what the ultimate rate will be that's applied to imports into the United States. The Cardinal strategy is always focused on companies that pay a dividend and they're high-quality companies. So during these times when the markets are a little bit more volatile, what you have is that dividend income stream is predictable, whereas the markets might be unpredictable. And there's a couple of advantages that come with that dividend income. For one, if you're drawing income from your portfolio, it can meet those needs, so you can leave equities untouched if they are down. And then secondly, if markets are down and you've got that dividend income coming in, we can take that income, reinvest in more shares, which increases your dividend income just by holding more shares of a particular company.
One of the main reasons why the Canadian and other economies continue to churn out growth is because governments are spending money in a big way. This obviously isn't sustainable over the long run. We believe the best hope is for Canada to search out new growth opportunities, such as removing interprovincial tariffs, reducing red tape, and developing more homegrown corporate champions, particularly in the IT sector. We take pride in investing in companies that excel no matter what's going on in the economy. Intact Financial, the largest property and casualty insurer in Canada, is one of those companies. Not everybody needs to be a customer of an operator like Intact. Only those who don't drive a car, own a home, or operate a business. So pretty much everybody. Robert Lamb, senior equity analyst, says Intact has an 18% market share, more than double of its closest competitor, and he expects its dividend growth rate to continue around 10% for the foreseeable future.
We also like it because it is the largest P&C insurer in Canada, and that scale builds upon itself in advantages. So they have the most data points available to them, which help both in risk selection and underwriting. And then on top of that, they are able to invest more in technology and internalize certain functions that competitors cannot. This includes legal services, repair services, investment management. So all of these things would otherwise be outsourced. They're able to internalize it.
8 of our companies increased their dividends in the quarter, led by CP Rail at 20%. If you had invested $500,000 in our Canadian equity portfolios in 1993, it would be worth almost $12 million today, outstripping the benchmark by nearly $5 million. And all of this demonstrates our commitment to clients, a common sense path to long-term wealth, because it works. And that's the Cardinal Commentary for the Canadian equity portfolios. Thanks for joining us.